everyone. Welcome back to another Chat with Traders community presentation. And I'd like to welcome back our previous guest a couple of times. His name is Erik Smolinski, and you can hear all about him in episode 272, and also the part one of his options presentation a few months ago. So, Erik, welcome back.
Ian, it is great to be here. What a great time to talk about options. We're starting to see a little bit of volatility in these markets, which is exactly what we need to see, at least from my world. It's much better this way.
Oh, great. Maybe get a little more premium for any options we might sell if we go down that path.
It's not just from a seller's perspective. That's actually like a common thought process, and it's not wrong. But typically when we see accelerated volatility, it helps premium sellers, but it actually also helps buyers in some degree. You're buying options that are more expensive, but you're getting movement. That's the nature of volatility. It means things are moving around. So if you're doing a good job buying options and you're being either directional or you're finding things that the volatility in that individual product is continuing to expand rapidly, it's actually a good thing for them as well. The way to think about volatility specifically is it's kind of the lifeblood of options traders. Whether you buy or sell, you need volatility, because even if volatility is super, super low and you buy options, you can't make any money if they don't go in the correct direction, and you need magnitude in order to make some money. So, you know, there's always nuance to that. You don't want to buy things super expensive all the time, but yeah, volatility in general is what we want to see for what we do.
Great. Before we dive in, just want to remind everyone, if you have any questions along the way, please ask them in the chat window, or open up the mic, and love to hear your questions at any time. So, all right, Erik, what would you like to show us today?
Beautiful. So there's a couple things that I wanted to start with, and then I know that there were a handful of questions that folks had that I want to make sure that we spend some time on. I noticed, especially for getting into some of the nuance on looking at options chains and stuff like that, I want to make sure we have a few moments to work through that and actually get to a decent level of detail. So what I want to start with for today, though, are reasons to trade options. So for those that don't know, the first session we did was kind of like a super high general overview of options trading for stock traders. And it's a bit of a different take, because the way that a stock trader might integrate options is kind of down a certain path, and then you can have the broader world of options and how you can maybe integrate some of those strategies as well, but you should also be familiar that they exist. So I'm actually going to share my screen real quick, and then I want to start us with a quick overview of some of these concepts. So scoosh that down just a little bit. And there's a few things that we'll cover. The first thing is, when we trade options, we add complexity. And that actually confuses a lot of people in a few different ways. So what I mean by this is, think of it this way. If you buy stock, the stock can do two things. It can go up, it can go down. It can go up and down in tiny little movements, but it's still going up and down. Like, those are your two choices. That's what's going to happen. When you start trading options, you integrate a lot of other things, because when we think about the world of options trading, something that people take for granted sometimes is that all options expire. So not only do you have to be correct in terms of a directional assumption, but now you're also integrating these other factors, like volatility's impact on options, which we were just talking about, is actually pretty massive. The rate environment impacts options chains, specifically as you go further out in time, but nonetheless, it's a factor, especially with the way that markets are today. And then we also have this time frame component. So then the question becomes, well, Erik, why are we talking about trading options if it starts to add all of this stuff? That sounds kind of lame. And you wouldn't be wrong for thinking that, because it does add a little bit of difficulty what we're doing, but there are some very specific reasons why we do this. And it really boils down to these 2 points right here. where options are strategic investments in that you really get to build the exact exposure that you want. You cannot do that with stock. If you buy stock, you have a Delta One product. You can control your size, which is super important. You can control how you choose to scale in, scale out, what rules you apply before you buy. All of those sorts of things are fully able to be customized by you. However, you lose a lot of the nuanced components that options provide, which we'll talk a little bit about. So I then offer to you a few reasons why we might want to trade options that you cannot find in stocks inherently. Some of these you can, but others you can't. So this idea of leverage, I'm sure people are familiar with the term, but a quick overview, leverage simply means that if you put up $1, you control more than $1 of value. It means that you now have a slightly different risk reward profile. Leverage can hurt you, but it can also help you. The other thing to know about leverage is it actually helps quite a bit with capital efficiency, because if you can gain similar exposure to something that typically might cost you $15,000, but you can replicate that position using $3,000, you've now just unlocked a bunch of capital that you could do other stuff with. So leverage is a really important concept with respect to options trading. Hedging risk is one of the most common uses of options. It's actually why they were invented in the first place. And it's part and parcel to some of the behavior that you'll find with options. And the other thing to know about hedging risk, though, with derivatives is that it is expensive. So one of the things I find retail traders start doing over time is they get way too risk averse, and then they want to hedge everything away. The problem is that costs money. So you have to be very thoughtful about the way that you choose to hedge a portfolio. There's lots of ways you can do it, and options do provide you some different choices in that end, which we can talk a little bit about that. Direction optionality is kind of straightforward to a degree, but let's say that you want to buy a stock because you think it's going to go up. You can replicate that with options. Let's say that you want to short a stock because you think it's going to go down. You can replicate that with options. So then in those scenarios, why would you use options instead of stock itself? Well, first, the stock could be hard to borrow. Second, when you're shorting stock, you're borrowing it and you're paying interest on what you're borrowing. Again, not the end of the world, can be part of your plan, but just another factor to consider. Then you have the different payoff profiles you can build with options that, again, you cannot build necessarily with stock outright. So not only does it let you trade pretty much any market direction, including flat technically, but you also get to create different risk reward profiles that you can't do with stock. You buy stock, it's going to go up, it's going to go down. Those are your choices. With options, based on how you choose to set them up, you can have what we would call defined risk or undefined risk, meaning your position could experience massive moves and it can essentially move one-to-one with the underlying, very similar to stock. But you can also set up positions where your max risk is defined. The most you can lose is built at the onset of a trade. So if you're looking at the markets now and you're finding things that are falling out of bed, some of them, if you're trading stock, can be slightly problematic. Not all that glitters is gold. Remember, as I talk about these different benefits, you have to remember the drawbacks though. And there's a dance that goes on in between these different tools and the different aspects of these tools that you have to find what's right for you, because it's not all the same for each trader. Couple more here. Trading volatility is one of the coolest parts about options, hands down. It's a non-correlated asset class. It's something that behaves by itself. So even if we're going through market periods where we're not seeing a bunch of appreciation, if we're not seeing a lot of movement in things that we want, you can still trade volatility. The other thing about trading volatility that's very different than trading stocks themselves is volatility is, in my opinion, and kind of from a quantitative perspective, way more predictable. And depending on the time frame, to be clear, because we know stocks exhibit positive drift over time, there's an equity premium, and that's quite predictable. But with volatility and also other time frames, for example, if you're familiar with the volatility index, if you ever see that spike, you know with near certainty, at some point in the future, it's going to come down sooner or later. The VIX has never stayed above 80 into perpetuity. Always comes down. So you have different exposures that you can provide that can actually supplement a long equity portfolio by integrating some of these other tools. Another cool part about options is income. So you can derive income from stock positions, but you have to liquidate portions of it, take that capital out, withdraw it. With something like options, you can actually trade around existing stock positions, let the stock position continue to grow, but then use the options for income against something that's already being essentially consuming capital via your long stock trade. The other thing to think about is, again, the periods where stocks don't move that much, you have opportunity here. Now, I want to be clear, in my opinion, options are not better than stock. I don't think that at all. I think that they provide different cost benefit analysis. And for me, at least, they each have a place in my portfolio for a lot of these reasons. The last thing I want to highlight out of this list on another reason to trade options is to benefit from what we would call structural alpha. Now, when you look at markets, there are different phenomena that we know exist and we can study. So one that stock traders might be familiar with is post-earnings announcement drift. This tends to happen specifically with small to mid-cap stocks, not so much large cap anymore, although they can. And this essentially says either to the upside or the downside, if you experience certain criteria going through an earnings release, that the next quarter tends to drift in the movement that you saw during the earnings beat or miss and the subsequent movement of the stock. So it's not just about if EPS came in good, it needs to be good enough, but then you also need to see initial movement post the release. That's post earnings announcement drift. You could trade that to the upside or the downside, and you can use stocks, options, whatever. But structural alpha also exists specifically in the derivative space. One of the things that we talk about is this thing called put skew. Have anybody here heard about put skew? And if not, let me grab another thing to show you guys, and we can take a peek at put skew together. So if we grab something like SPY, and let's say that we know about trading options. We're here checking out an options chain, which we'll learn a little bit more about as we kind of click through. We can answer questions while we're in here as well. But if you look at a tool called Delta, this essentially is just a measurement of an option, the way to think about it. And Delta represents the rate of change of an options premium, which is over here, for every 1 point move in the underlying. So as SPY goes up by $1, you can see that the delta over here is negative 30 cents. So all this means is this options chain will go down by 30 cents if S&P 500 goes up $1. Now, there are other things you can derive from delta. I'm not going to go super far into that just yet. But what I want to show you is if we compare apples to apples, if we look at a 30 delta put, in this case, you'll see that those are trading for $4.96. Don't worry about how any of this works just yet. I just want you to think about that value, $4.96 when we're looking at a 30 delta put. If you come over here, and we kind of have to use a midpoint here, we can just use the 31 delta call, which is right here. This is trading for $4.06. So what did we just find? Well, you just found for something that has the same delta in the same expiration, on the put side is trading for essentially 90 cents more than it is on the call side. Congratulations. You just found an example of structural alpha. The puts are overpriced relative to the calls. Now, typically there's a reason for that. People fear the downside. And I'm sure you've also heard the market tends to take the elevator down, the stairs up. So this isn't, oh, this is easy. This is just overpriced by 90 cents. Let me replicate it and capture that profit. No, there's a reason why it's there. However, in general, over the long run, that overpricing actually produces a structural alpha. You have to be able to withstand the drawdowns as they occur. But this is absolutely another way people can integrate options into their toolkits, is to find things like this and figure out how you can use options to extract some of this excess value. Because you have to think of it, why would this be overpriced? Why would this be trading for 90 cents more than the call counterpart? Clearly, there's demand. That's what moves price. But why is there demand? Well, it's because there are people who are running pension funds that are trying to hedge an entire basket of stocks. They can't go through and hedge every single piece in there. It's very time consuming and very expensive. So they find something like SPY and they say, let me just replicate a certain part of my portfolio using these options to hedge my downside risk. Why are they doing that if it's expensive? Because they want to keep their damn jobs. If they start seeing in a pension fund too much portfolio volatility, that guy's out, the next guy's in. So they'll willingly overpay using fund money in order to keep the fund stable and keep their jobs. Again, there's tons of scenarios that can lead to this, but I'm giving you an example on why you will find instances like this, where puts tend to trade more expensive than the call counterpart. So I'll take a,
quick question. So as the volatility goes up, as measured by the VIX index, say you get a really big sharp market decline, does the put skew almost always or always increase as the market plunges?
It's a great question, and we have to break that down in a few different ways. So the first thing is we have to decouple the idea that VIX goes up, market goes down. We have to break that apart because, to your point, in general, that's what you'll see. However, you'll also see instances where volatility starts to expand and the market's still going up or the market's going sideways. So the way to think about VIX is that in general, and for those that don't know, this is tied to the S&P 500 index. So you're looking at the forward 30-day volatility as you look at this. So, and it's annualized. So when you see VIX going up, that doesn't inherently mean S&P down. It simply means volatility is expanding. Our expectation of market movement or gyrations is expanding. Again, just to decouple that slightly, because sometimes people can get too attached to that and it can actually cause problems. Now, going back, and again, to your general point, when you do see VIX spiking, almost always the S&P 500 will be going down. If the VIX is kind of having these smaller gyrations like this here, where we go from 1273 up to 14, the S&P 500 might not be going down at all there. It literally just might be experiencing an increased expectation of volatility. Now, as you were referring to, if we have the scenario where VIX is spiking, and if we have the scenario where the S&P 500 is in fact falling as it is now, when we see this kind of market behavior, think about what's happening to people that are not hedged currently. They are scrambling to put on hedges because they don't want to get stuck during this massive drawdown. So you can see this in a few different ways, but more often than not, demand and supply have a relationship with one another. If markets are becoming more volatile, if they're exhibiting downside movements, more often than not, you're going to see puts trade even more expensive, exactly as you deduced, than the call side. And it's because if a trader like me or other institutions, market makers, if they're going to step in front of this to sell and provide liquidity to provide puts for somebody that wants to buy them and protect their risk, I demand a premium because I know if I'm selling puts, this is going down. That's the wrong direction. So there's a chance that I get ran over in this instance and I have to have a bailout plan. So during periods of market downturns, you generally will absolutely see severely expanded put skew. The other thing that you'll notice during big downturns, which I want to differentiate quickly, I know that there's like a lot of people like losing their hair right now, the fact that the S&P 500 is going down at all. But just to put things in context, we've gone from 52.64 and we're down at 50.22. So if you're decent at math, it's about 5% move. So we're not even into a correction yet. We're literally just, this is the infancy of a pullback. And that's not to say that this can't accelerate, get worse, yada, yada, yada. But the point I want to make is look at the move it's made. It's got to come down at some point. Things don't just go up forever. There's always going to be periods of digestion. So I just want to bring that up because this actually isn't a great example of some super highly volatile market where you can see really wide liquidity gaps, but you'll still be able to see some of it, which we can take a quick look at, where normally liquidity, and obviously markets are closed right now, but normally liquidity for something like SPX will be very, very tight. It is now. But the other thing you'll notice is as volatility does spike and as markets start crashing down, you will find that the bid-ask spread widens more and more and more. It's actually a natural circuit breaker for the stock market because as things start to get so liquid, nobody's willing to transact anymore. It puts the brakes on serious price movement, but it also offers fantastic opportunities for traders that are able to handle volatile periods because there's so much meat on the bone because people are so desperate to get a transaction that they're paying way more than they should just to get a fill. So it's a really long answer to a simple question. And the succinct synopsis is absolutely when VIX spikes and S&P 500 are plummeting down, you will notice in S&P 500 products and specifically S&P 500 products, the put skew will expand. You actually track this. It's pretty easy to create different visualizations of volatility for different time periods. So we have things called a volatility surface, a volatility smile, term structure. It just helps us see how expensive volatility is compared to different periods and so on and so forth. But in general, when you see the market start collapsing or individual products, and that's another thing to differentiate quickly, is if the VIX is up a lot, this doesn't mean everything is now more volatile. This means that the S&P 500 is more volatile. You can have individual stocks that don't care about this. Typically, most of the market, when the volatility index is high, you'll notice expanded volatility typically. But again, it's just important to decouple VIX, which is S&P 500, from volatility for everything. Sometimes you can have individual products that might actually be completely decoupled from this right now and feel none of it. But in general, when you see these kinds of movements, especially in the S&P 500, especially when it is slightly more voracious, like it is over the last couple of weeks, you tend to see markets feel this across the board. But yeah, I think one of the things to keep in mind is as things get more expensive and as volatility starts to expand, opportunity opens up pretty significantly.
Great.
Yeah, really long answer to the question. Now, let's take a peek at these real quick. And I'm just curious if anybody has any questions or thoughts on these different reasons to trade options. If so, happy to talk about those. If not, then I'll go into a little bit about how I think about trading options and some of the specific strategies that I use. Cool. Easy enough. So let's start then with my go-to strategies. One of the things you'll find with options traders is there are a million different structures. And I want to differentiate quickly the difference between an option structure and an option strategy. Super pedantic, but useful to know. A structure is just a configuration of options. If you buy a call, that's a structure. If you buy a strangle, you buy a call and a put, that's a structure. A strategy then is the rule set that you apply to a structure. So if you buy a call at a specific support or resistance level and hold it for X period of time before you sell it, now that's your strategy. That's predicated on a long call structure. So when I look at my strategies, something I think about is how do I gain exposure to everything the market can show me without adding a bunch of noise? And unfortunately, the options world is confounded with structures. There's a million structures. You could have all different kinds of legs of an option strategy. And what I mean by that is if we take a look at something like Tesla, just to grab a name, and it's down in the dumps here, great. And we say we want to trade Tesla. Well, you can come in here and you could say, well, I want to go 30 days out and I think it's going to go down. So I'm going to buy an at the money put. Then I'm going to sell a near term at the money put. And then I'm going to go further out in time and buy another put. Like you could just layer on a bunch of stuff. It starts to get overwhelming super fast. And people can get a little crazy with the number of legs that they include. There's nothing wrong with having additional legs for a strategy. But I do want people to keep in mind as you're building strategies, the simpler you can make them, the better off you're going to be long term. That's just how this works for a bunch of reasons. If you noticed before when we were talking about this idea of volatility is the lifeblood of options, meaning we want volatility. But I also told you when volatility is high, liquidity widens out. Things become more expensive. Okay, so then what's easier for me to get a fill on? A single option or 6 different legs that I'm trying to fill all at once? Well, if things are super illiquid, if I have one option, I'll be able to get a fill much easier on that. And again, when things are volatile is when options traders very much like to transact. So let's take a look at how I think about this problem set. What I want to do is have something that allows me to take advantage of different market conditions, but I also don't want to confound things too much. So in order to do that, I have things broken out into these different buckets. I can either be trading a bullish directional thesis or volatility. Bullish direction means I think something's going up. Bullish volatility means I think volatility is going up. And then same bearish for both. Notice how in here, I don't have the words neutral or no direction. I find retail traders, they get too addicted to this idea of being directionally neutral. And I actually think that becomes a disease because you get so used to not having to make a call or have a disposition towards something that you just start trading everything neutral because it's just a mental shortcut of, I don't have to think about this. I'll just put on a neutral trade because I don't really have an opinion. It's a tough way to trade. You're not going to make a lot of money that way. So the way I think about it is even if I don't have a strong disposition towards direction, the only reason then I would be placing a trade is because I have some kind of opinion about volatility. If it's the scenario that I have no opinion on direction and I have no opinion on volatility, what am I trading? What do I think is going to happen? It makes no sense. So you have to come up with a thesis on something. So that's how I think about the problem set. So let's take a look first at this bullish directional thesis. It's a simple list of 4 things essentially that I trade. I trade long calls, short puts, ratio call diagonals, and the covered strangle. These 2 single leg option strategies. This is a 2-leg option strategy. This is also a 2-leg option strategy that also includes long stock. We don't have to go super far into these. I just want you to see the names so that you're even generally familiar with some of the terminology. And then we can go into some really simple use cases of these in just a few minutes. Next up, bearish directional. Pretty simple. The inverse of these 2, And then instead of doing a ratio call diagonal, it's a ratio put diagonal. You'll notice that I'm using the same structures. I'm essentially just using the inverse of them. Another beautiful part about options is that once you understand the way that the structures work, you kind of are able to configure them however you want, yet again, but you don't have to add a bunch of new data into the mix. If I'm long a call, I want something to go up. If I'm short a call, I want something to go down. The main difference between being short an option or long an option comes entirely down to the payoff diagram, which we can take a look at very quickly.
Quick question on that.
Yeah, please.
I noticed you could go back to that screen.
Yeah.
Covered strangle for bullish. I don't see anything in the bearish column. Can you create an inverse of a covered strangle?
Technically, you could, but it's not a strategy that I run. So the way that the covered strangle is configured, which we can actually build one real quick together. In the hypothetical scenario, we would buy 100 shares here. So it would look just like this. Then we would sell. Let's just call it put 30 days out. It doesn't matter. So then we add that leg, and then we would sell a call like this. That's what it looks like. So the three pieces to this trade are long 100 shares of whatever you like. Then I'm selling a cash secured put, and then I'm selling a call against it. Now, typically the way I set these up is so that I would have at least a ratio so that I have uncapped upside potential. So if I were to sell one call, then I would want more than 100 shares is kind of a key part. I don't like giving up upside potential. If you're holding an equity, you're taking unlimited downside risk. It can go to zero. And if you're holding something that's long, that's your risk down to zero. What I don't like is taking that risk and not having some semblance of the commensurate upside potential. That's the benefit, that's the payoff of taking the downside risk, is you now have unlimited upside potential. That's one of the big issues I have with something like a covered call, actually. So if we get rid of this put and you look at this covered call, there's a reason why I don't trade these very much. It's because you give up your upside. It's gone. You still have all the downside, and it's there and it's looking right at you in the face. But you now have capped upside potential, which I do not like. I think it's typically a bad risk reward profile. As always, there are use cases for stuff like that, but it's not my preferred. So this is the covered strangle. Now, the reason why I don't run these to the downside is because it includes holding short shares and essentially inverting both of these positions so that it would look more like this. However, I don't like holding short shares for long durations of time. The covered strangle that I will run is generally a long thesis that I'm applying. It's actually why these are all slightly different, the risk profiles that they provide, because this is a long thesis trade. And you'll notice that I don't have a long thesis short trade. It's because markets exhibit positive drift. I don't want to hold something short for 3 years. It could go down, but in general, I'm fighting against the grain. So instead, I use kind of this intermediate strategy, this ratio call diagonal, to fill that space. So if I have something that's like a 3 to 6 month thesis and I want to trade it to the downside for 3 to 6 months, sure, I'll run a ratio put diagonal. And the cool part about these is these have defined risk. You know the most you can lose right at the onset of the trade for both of these ratio diagonals. When you trade something like a covered strangle or long shares, those are undefined risk. Same thing with the short put and the short call. Those are undefined risk strategies. The long call, the long put are defined risk strategies. So that's why I have a configuration of these. Because let's say that I'm looking at something that I want to trade to the upside, I'm bullish, but let's say it has earnings coming up. Do I want to buy a call or sell a put? Well, kind of a tough scenario through earnings, to be clear, especially holding options. But if you think of it just from the risk side of the equation, if we take a look at what these look like by themselves, the long call and the short put. So I will get rid of that. That's a long call. That's a short put. So if we take a look at the long call, notice how the long call has unlimited upside potential and it has a defined downside. And then if we look at the put side of the equation, short put, we have capped upside, unlimited downside. So very different risk reward profiles. And the reason why you would trade these two different structures is very different. And the way that I think about building an options trade is I think about how do I configure this so that it has exactly the risk profile that I want. That's the beauty of options. Because if you simply just buy the shares, this one, that's what you get. The 1 for 1, up and down. That's it. With options is completely different. I get to pick, do I want a higher probability of making a smaller amount of money and assuming downside risk? Or do I want to have a lower probability of making a bunch of money to the upside with defined downside risk? And you can make all different kinds of flavors of this. The next thing that starts to integrate into the conversation is cost. How much does it cost us to do these? But this is essentially the world of trading options. This is why it's so cool, is because if you want to buy Tesla, if you want to buy 100 shares of Tesla, it's $154.87 per share. Not cheap. So you got to put up 15 and a half-ish. Whereas if you buy this call, this one specifically, which to be clear is not what I would buy to replicate this, but just to use the example, it's $280. And you get this kind of payoff diagram. Slightly different. So far we have directional, bullish, bearish. Any questions on these? Beautiful. On to volatility. So for bullish volatility, this is where we expect vol to expand. If I have no directional assumption, I will trade either straddles or strangles. And I'll show you what those look like quickly. So if we just keep using Tesla because we're here, and let's say we take a look at Tesla, and for whatever reason, maybe the implied volatility chart down here or something makes you think, or maybe with earnings coming up, your thesis is starting 2 weeks out, implied volatility starts to expand leading into earnings, which is actually a thing. You can see it happening right here. It started a little while ago. That's a tradable event, by the way. That is an example of structural alpha. But as that happens, you could say, okay, I think vol's going to go up. I don't really care which way it goes, up or down. I just want vol to go up. Well, you can do that. You can pick a expiration that works for you. And typically you would buy what we would call the at the money straddle. So generally it'll be about a 50 delta call and put side. In this case, it's slightly skewed. That's okay. And we can essentially replicate this trade. So we would analyze buying this, come back over here, analyze buying this, and then we'll clear out this other noise so that we can look just at our straddle. So essentially this payoff diagram, it has a defined downside. So you know your max risk from the onset, and literally you just want it to move. You don't care which way it moves. It needs to go up or down, meaning we want volatility to expand, and we want to see a move that then puts us in profit in some capacity. Tessa, you have a question. What's up?
Oh, sorry, didn't mean to interrupt.
Not at all.
So since you're talking about this is for possibly trading earnings, right?
Yeah. Earnings with this.
I had a question from one of the members who couldn't make it today. Where would you, I mean, how close to earnings would you put on this earnings trade? And, you know, like weekly, would you use the weeklies or, and you know, what kind of strategy would you use or structure? Strangles, straddles, which you're showing to me now is a straddle, right? And do you sell them the day of or after announcement? Maybe if you can kind of run a scenario for a possible earnings play in this.
Let's do it. So there are two effects that we care about for earnings. The first effect is the expansion of volatility leading into the earnings event. That starts up to 2 weeks out from earnings. Then post earnings, we have an implied volatility contraction. The way to think about the contraction and expansion of vol around earnings is, think of it this way. During earnings, we are receiving a lot of information that directly impacts the value of a stock and people's perception of the value of a stock. So leading into that event, volatility starts to climb. People are becoming anxious, and the market is now trying to determine how big of a move is going to happen after all of this information is quickly digested into the underlying. That creates volatility. So you can trade the expansion leading into earnings, and then you can trade the contraction post earnings. So to trade the expansion, we typically would want to start again about 2 weeks out. I tend to look at buying straddles, and it gets a little more complex because I do something called gamma scalping, which is probably a little heavy for the conversation here. But the idea is when you buy a straddle, I then would trade around it, is kind of the way to think about it, to make sure that I'm isolating volatility by itself. But you don't even really have to do that. So let's say I see waste management out a week from now. So let's take a look at waste management. I don't actually think waste management is typically super volatile. So the first thing I'm doing is seeing how is volatility historically behaved leading into earnings. And it's kind of flat. It's not super appealing to me. And there are other ways you can look at it. I'm just trying to eyeball real quick to find a decent example. So I'm actually going to go to something else. What I'm highlighting right now is something like waste management. It doesn't necessarily have a ton of vol, or it's already priced in, which in this case, it's essentially already priced in. We're late to the punch. Because do you notice how I said 2 weeks out? I just told you that waste management has earnings in a week. So if we go back another week, notice what happened to implied volatility. Implied is this yellow. Do you see how it goes up? That's the expansion of implied volatility leading into earnings. And you'll almost always see this to some degree. So here's earnings again. And if we go back 2 weeks-ish, you can see that it climbs leading again into earnings. It's a very repeatable thing. So with that, we can use this for an example. I was trying to find something a little more extreme, but let's just say that we want to trade this for earnings. What I would do is I would find where the earnings cycle is. That matters a lot. And I can tell you where it is simply by looking at the volatility in these options chains. This looks at the implied volatility for each expiration cycle. So you notice we have all these different dates. This is just options chains that are then built of individual options. The implied volatility tells us relative to this time frame, how much do we think the product is going to move around. So you'll notice in this case, this one is 19.6% vol, okay? Doesn't have to mean anything to you. Just look at the pattern. Then it goes to 39, then it goes to 29, 25. If I told you that earnings is where things tend to be volatile, and we know earnings is coming up, where would you deduce earnings is across these chains? Simple, where it's the highest.
The May 3rd.
Here. Yeah.
Oh,
so,
no. Yeah.
Yeah, so it's actually reporting on the 24th. So you can see that this 26% or this 26 April 9 DTE, notice how this is the highest. Exactly where we would expect to see earnings then. So now going into the corresponding expiration cycle to earnings, which is very important because again, let's just say that you bought the straddle and you went out here to 30 days. You're not seeing any of the move, because we don't know if it's going to move a lot post earnings release yet. If it did, this would get impacted, but we don't know that yet. The only thing we know is that going into earnings, we expect vol to expand, and that's why this is so high. So we can isolate that. Then we can say, I want to buy the at the money straddle. So again, we would come in here and essentially buy two verticals. And for those that don't know, one of the reasons why I'm not just like doing buy straddles, I want you to see the individual legs by themselves, but you could always just buy the straddle itself. So now, essentially, we just want movement or we want volatility to expand. Notice a couple things. Notice that there's the purple line and the blue line. The blue line is at expiration. The purple line is today. So the longer we hold this, the bigger of a move we need in order to make money. So if I start fast forwarding time, you'll notice that purple line goes down, goes down, goes down. And the spot that you start making money goes further out until it assimilates to this blue line. So not only do you have to be correct in terms of your disposition, but it has to be timely. That's why we have to research this effect. And this is why I can tell you typically 2 weeks out is when you will see implied volatility start to expand. So you can play the expansion in volatility by buying something like this. And then as we get very close to earnings, right before the close, before it reports, I would then flip the position. And I would either sell a short straddle or a short strangle. Thor also agrees, I think. That's what he was saying.
Wait, so do you hold that? I mean, do you play it during earnings as well, or do you or did you just say you would convert it?
Yeah. So essentially what I would do for like a simple roadmap, and again, the devil's in the details on stuff like this. I wouldn't apply the same thing to every single position. Sometimes you have to get a little more specific, but in general, if you buy a straddle 2 weeks out and then you sell it close to earnings right before, they tend to be positively expectant. So in this case, I would buy the straddle that is 9 days out, and then maybe 1 day before earnings or on the day of earnings before it releases, I would sell it. And then I would enter the opposite side if I wanted to trade the contraction of volatility. But there's a little more homework that goes into the selling side of things as well, because things have an expected move where implied volatility is being priced, where the market thinks the move will be. And if you're selling, you need the product to stay within that expected move. But you can find products that have a history of jumping more than the expected move. You don't make money on that if you're trading short premium strategies through earnings. So there's a little bit of a diligence process that goes into analyzing the previous earnings moves, which again, I can show you exactly what that looks like. If we go into analyze earnings, that's what this is. These two different lines, notice how it says implied is the orange, historical is the yellow. What we want to see is two things. The first thing, we want to see implied expanding into the earnings release, which again, you can see right here. The implied vol in this release went from 23.08% to 30.42%. If you bought a straddle, you would have made money here. Same thing here. This went from 24.53 to 27.9. Again, if you bought a straddle, you made money. Not always the case though. So you'll find instances sometimes where it can actually peter out a little bit before the earnings release, but in general, that's what you'll see. Now, post earnings, what we want to see is the implied maintain above the historical. So if you see this kind of scenario right here, where we go into the release and then the historical skyrockets past the implied, where it was implied at before the release, that means it moved too much. So you had sold premium expecting that it would be less than this, and it turned out to be slightly more. You would have lost a little bit of money here. So that's kind of a general way to play the run up. And then the contraction side of things, I typically would sell the straddle or strangle right before the release, right before the close. And then I would wait until the next day. I would give the open at least 15 minutes, if possible, to digest all of the volatility out from overnight orders being filled. And then I would look to exit soon thereafter, or you can hold it as long as you want into expiration. There are some things that are slightly more profitable in that way.
Thank you.
Yeah, of course. Trading earnings gets a little heavy. There's a lot of nuance to something like this. It's part and parcel of trading options. In my opinion, it's one of the best things you can gain exposure to, but it can grow teeth. And if you're not ready for volatility in your portfolio, it can be very difficult to manage it. Yeah. Good question, though. All right. Back over here, we actually just kind of had a bit of a conversation about trading the expansion and volatility and the contraction. The way to think about the difference between straddles and strangles is straddles tend to have a lower win rate, higher average profit, higher average loss. Strangles tend to have a higher win rate, lower average win, lower average loss. So that's kind of the simplest way to think about these. And then I put long calls and puts on both sides because you can combine a bullish directional and volatility thesis. So that's all that is. That's getting directional with your volatility and whatever you think the underlying is going to do in terms of a delta move, the directional move, but then also in terms of volatility. But if you want to isolate them a little bit more purely, this is the way that I would look. So with that aside, that gives you an idea of how I look at these things. If I think about the world for most folks here, stock traders, I think about what would make sense to start integrating into a stock trader's portfolio. And for me, the answer is actually pretty simple. I think that if right now somebody likes buying stock, adding things either like the covered strangle or a ratio covered call is probably one of the leading bullish directional plays I would integrate. Same thing with the ratio call diagonals. These would probably be the two I would start with. If I was wanting to add bearish ideas, I would look at things like ratio put diagonals and long puts. The reason why I don't include short calls right in the beginning for kind of a newer trader that might be looking at this stuff is because the undefined risk side of these can hurt really bad. And there's a lot of ways you can trade these and make a lot of money, but you have to be careful. So I would start with stuff that I would consider to be slightly more conservative. Now, there are structures called vertical spreads, and I have a special hatred in my heart for those. Although they are completely viable for newer traders. It's kind of like trading with training wheels, and I don't actually mean that in a negative way. The downside to it is if it were me and I was starting to trade options and I wasn't ready to trade these kinds of strategies, then I would just paper trade. I wouldn't bother trading what I would consider to be a less effective option structure just because it's what I was comfortable with, what I could afford. I think it builds a lot of bad habits that then have to either get undone later. And the other thing is you waste a lot of time tinkering with something that you're not actually going to apply somewhere else. But all that being said, there's nothing wrong with verticals. If you like verticals, instead of trading short calls or long puts, you can trade a short call spread, a long put spread. You can add spreads to these, spread off the option, but it's just not what I would do personally. And then for volatility plays, I think the simplest way to start would probably be long straddles. And then for bearish side of things, probably short strangles is what I would start with. Now, the volatility side of things, an entirely different asset class. If you're not looking to trade volatility, literally just put a line right through all this. Don't worry about it. But if you're interested in expanding your options trading skill set, I do think trading volatility is probably one of the best parts about trading options. So it's something that even if you may not want to integrate right now, it's something that I absolutely would consider at least testing on the side, getting some exposure to it, tinkering with it so that you can see, what you think about it, how it works for you. Because again, one of the cool parts about trading volatility is it provides a non-correlated source of returns for a portfolio, which is pretty slick. So those are a few reasons why I think trading options make sense for most people to different degrees. Those are my go-to strategies. Those are essentially what I trade almost every day. I was trading 0 DTE SPX options, and I was trading short strangles in there today. And then right now in different products, I have stuff like covered strangles on, and I have ratio call and put diagonals on. It's mostly what I'm trading right now. So happy to take a pause here and dive into questions. I know that we had a few of them. I also got a couple sent to me via the chat feature, so we can start wherever you guys want.
Is it, you mentioned earlier, Erik, like for someone starting out who would normally just trade stocks, the direction would be probably the easiest way to start out? Is it because it's very similar to almost, because it's directional, it's similar to trading stocks, trading shares, right?
That's exactly right. Yeah. So the reason why I think that is because it lifts and shifts all of the analysis a trader does now to buy shares or sell shares. It's the same for options. You're just using a different product instead of the equity product. So I think for a lot of traders, one, trading those thesis tends to be an easier corollary. And the other thing I think is you actually will find that in some of these instances, depending on the standard hold time for your equity products or what kind of equity products you trade, options can actually be way more capital efficient for you. Now, there are caveats to this. So like if you're a small cap can slim style trader, you're going to struggle to find liquid options in those products. So I wouldn't trade options there. It's not a good fit. It is important to be product open, but also to have specific criteria that you're looking for. So Tessa, that's exactly right the way you're thinking about it. The reason why I would start with those is because you get to lift and shift your trading worldview, your trading analysis for finding products, but instead of using long shares, you can use something like the covered strangle ratio call diagonals, even long calls. Again, I probably wouldn't go short puts too early before there's time to tinker with that, but you're not going to hurt yourself too bad with something like a long call. It has defined risk out of the gate. You can absolutely lose money if you're wrong directionally, and it absolutely will amplify it to a degree because of the velocity of options. But the point being is you're not going to do what a lot of traders do, which is step in front of a moving train, not know it's there, and then blow an account out, as long as you're buying things that are cost appropriate for you. If you have $1,000 account and you're buying a call option that's $800, I mean, it probably would sound crazy to most people, right? To load up 80% of your account in something. But, if you apply standard risk protocols to stuff like this, it could be pretty much a suitable replacement in a lot of ways.
Thank you.
Yeah, for sure. So Quinn sent me 2 questions. And we can start with a couple of those. The first one says, I would like to know more about put call ratio. Now, can you talk to me a little bit? Are you talking about the put call ratio as I was talking in terms of the options chains, like here as an example? Are you talking put call ratios based on open interest or in terms of volume transactions? Or are you talking ratio spreads? Okay, so you're talking about this. Got it. Thanks. Yeah, so put call ratio is a really useful tool. And it's important to have context about what you're looking at. Now, in this case, we can see the total volume of options transacted today in waste management, because what we happen to have up. And you can see that 961 calls were transacted and 997 puts. So it's about 1-to-1. That's not really telling me much of anything. Now, what you'll notice in general is if you look down here at total open interest, again, this is a bit of an anomaly, to be clear, where waste management call open interest is 23,400 contracts, and this is 25,000 for the puts. Near 1-to-1, which even that in and of itself is slightly telling for me, because I know in general, you're going to see more OI, open interest, on the put side because people tend towards puts. So if we take a look at something like QQQ, and we close this out so we get to the bottom. Notice the difference between the call open interest and the put open interest here. 6.8 million puts to 4 million calls. What can we deduce from that? Well, it tells me that lots of people, 2.8 more million transactions occurred on the put side. It's a significant amount. Now, conversely, if we take a look at the transactions for today, the total volume that we see flow, let's take a look at like a near-term expiration. I got to move this. You can isolate this by different expirations. So for the 17 April expiration today, we can actually see that people were trading to the downside, 143,000 puts to 116 calls. So what I'm doing right now is I'm flipping through, just looking for anomalies like this right here. The 19 April expiration, 1.3 million puts, 815,000 calls. That's a lot of put skew. So again, that tells me in general, this is about what I would expect to see with more put OI. So as I look through these, I can look for areas where either they're closer or even areas where there's call skew in terms of open interest. And this can give you some ideas in terms of where the market thinks things are going to go. So this is a good example right here. In 24 April, over this time frame, notice how there's actually call skew. We see 22,800 calls against 17,640 puts. I just showed you a bunch of different other expirations where it was always the other case. So you've just found an anomaly. Something is happening here. Somebody somewhere for some reason believes, to at least a small degree, more upside potential than downside. Now, this isn't massive call skew, to be clear, but it is call skew nonetheless. And it's a decent example, at least to get the idea going on how you can look at that. Now, going back to the pricing of options specifically, which I can try to make this fit better. So now going to the pricing of options specifically, if you go into different time periods, you'll tend to find across different expiration cycles where puts will trade more expensive relative to the call counterpart, but not always. So in this case, these are weird strikes. This will happen sometimes for different settlement reasons. There's a dividend, a buyback, like those kinds of things. But if we just take a look at, let's say this 405 in 65 days, 25 delta put, these are 6, 38, 37, something like that for 25 delta. So if we come over here, the call side is only 477, something like that. So the point is, right now, this also has significant put premium priced in. So this tells me over this time frame, people are absolutely hedging to the downside. So let me know if you have any more specific questions on kind of put call skew, which is this, or the question you would originally ask, which is put call ratio, which is more tied to this. So I kind of bundled them both in together for you, but happy to go into any more detail on those. For put call ratio, you can use it to come up with ideas, again, just on how the market thinks something might move is what it boils down to. But you can't take it at face value. You absolutely have to do a little bit of homework behind the scenes to see like what is normal and then what's abnormal. That's really what you need to pay attention to and stuff like this, because you can have stuff that typically has put skew and that's just normal. That doesn't mean the market's crashing. It could just mean people carry hedges in that product all the time. So then if you looked at that one time and you said, whoa, massive put skew, let me, maybe come up with a trade thesis to the downside here. And then you just lose money and you're like, well, what happened? What happened with all those puts? Well, those just might be people who are hedging a portfolio and they don't really care. But if you notice something over the course of a few months that typically has, let's call it 6.8 million put OI, open interest, and let's say that you see that jump to 14 million, giant blinking lights draw my eyes to that. That's very different than what it typically is. And now I'm very interested as to why that's the case. And then that's when you'll see me go through and do something like this click through on the expiration so I can isolate where that's happening and then see if there's any news tied to that release, that kind of stuff. And then the other question you had was on open interest, which is actually kind of convenient. We were just talking about that, and volume. So I'm actually curious for you guys. Do you guys know the difference between something like this, open interest, which is right here, and volume, which you can also see these in the options chain? I don't know if they give you a view of it down here. It doesn't look like it, but you can take a look in the options chain. So this column here is volume. This column here is open interest, what we would call OI. Anybody know the difference between these?
Isn't the open interest the total accumulated positions in that particular strike, and the volume is just the volume for that particular day?
Yep, that's exactly it. So this essentially, this 868 overnight, this is what transacted today, depending on what's net new, net loss, will get added to this number, and then this will be a floating number going forward to show the total exposure. Exactly right. Cool. Well, those are Quinn's questions. Happy to answer any more of those, unless Ian or Tessa, if you guys had any other questions, but that is mostly what I had for us today.
If you have time, Eric, I had
Yeah,
just a few more. It's more process oriented. And some of the questions are is from the member that who couldn't attend, but so what percentage of, it's more like, what percentage of your account do you risk per trade? And then another question is, and it's really actually from me, do you use a top-down approach, looking at the markets first, and then to scan for, options to trade, and then drilling down to, the individual stock that you're interested in? And do you follow, like, where the institutions are trading and options order flow, like from spot gamma? I know that's a bunch of questions, but
no, that's super simple. So the first question on risk per trade, that is not standard for me, and it really does depend on the individual position that I'm running. In general, I think keeping less than 15% of the account at risk in any one single trade is good practice. And I say 15% on like the very high side. You could absolutely go even higher. I have periods where I might centralize 95% of my portfolio into an individual product, but that is a very specific style of trading with a very specific purpose and use case. That's not something I would generally run most of the time. I think realistically, most of the time I would look at 5-10% of the portfolio, but some of it depends on the payoff potential as well against the risk profile of the trade. So I don't just look at how much capital is being used in a trade. I look at the value at risk. That matters to me even more, because I could have something that I have a really, really strong disposition in that I think is, on some sort of pivot and going to start running back up. And in order for me to play that thesis, I have a very tight stop in it. I have no problem putting a bunch of money into that trade and then weighing the position based off of the value at risk at where I would be exiting otherwise. You do have to be mindful of gaps and things like that, so you can't get too reckless. But if I'm trading something like a covered strangle in an index ETF like IWM, I've never seen IWM not make new highs at some point. Could definitely include periods of holding while it's down, which is not my go-to. I would be trading around it. But the point being is I have no problem sizing into stuff like that. 95% of the portfolio, even 100%, even leveraged. I've had periods where I've been over 100% invested in stuff like that. But I think in general, for most people, at least in the beginning, like 5% is fair. It's enough to give you a good look if you're using enough positions that will give you decent sizing to see some movements until you start getting confidence to build convictions to size positions up. I think one of the issues retail traders get stuck in is they are told, you have to be careful of risk, be careful of risk, be careful of risk. Don't risk more than 2% of your portfolio in a position, which, again, not saying 2% is bad necessarily, but it just, either you have to run a lot of trades all of the time and you have to hope you get a big enough move in most of them in order to make any meaningful amount of money. Just a tougher way to do things. Again, I wouldn't say that it's not viable. A lot of the sizing conversation is going to come down to the individual trader. Now, the last thing I'll say on sizing specifically really comes down to the strategy. So if I'm trading something like earnings that I know have much higher volatility, that's not where I'm going to put 15% or even 10% of my portfolio. That's where I probably would definitely stick to 5% and maybe even slightly lower than that. That's a numbers game. In order to make it through trading earnings, specifically earnings releases, the contraction of volatility, you're going to have some big losing positions. The only way to offset that is to have enough of them on, and you might even have a really bad cycle that you lose over the course of an earnings quarter that you're net negative. Typically not awful, but it definitely can happen. So you have to be prepared to weather those kinds of storms. So again, for a more speculative strategy like that I know has higher return variance, I'm going to size small. If I'm trading something like a breakout play to the upside that I have pretty high conviction in, for something like that, I absolutely might add a little bit more risk to that kind of thing, as long as there is a defined risk management profile to the downside. So I definitely view that as slightly variable. And then as for the other question, specifically using some of those various options tools, I think there's a use case, but there's nothing novel about them. That's the way I think about it. You can use gamma, spot gamma, you can use gamma walls. There's nothing wrong with it. You can integrate it. I don't personally lean too heavily on any of them, but there are people who do trade more heavily around those tools, and it can be done successfully. It's just not the way that I tend to trade. Most of what I'm trying to do is gain exposure to multiple time frames with different asset classes at different sizes with different strategies, so that I'm able to kind of pivot around successfully. That's why right now, as the market contracts a little bit, I'm still in a completely good spot, because I have short delta trades that are starting to come on and will scale on, and it gives me a really good opportunity to pivot some of the portfolio into things that are following the current trend. So if there were a couple other parts, that second part that I missed, let me know, Tesla. I'm happy to circle back, but I obviously clinged on to the spot gamma.
Oh no, yeah, and the other part was just more general, like how do you take a top-down approach, looking
Oh,
at
I
the
see.
overall
Sorry.
markets? Yeah, looking at the overall markets and then the sector maybe, and then down to the stocks.
Yeah, definitely. So, and that's quite literally exactly what I do. I have a couple of videos on my channel that talk about kind of my process for placing and scanning trades, but really the entire premise of what I do, it starts with a very loose economic view. What do I think about just the current economic health of the market that I'm trading, typically US markets? Then I'll take a look at the broad stock market, see what that's doing. Then I'll take a look at sectors, subsectors, commodities, see what they're doing. And then all of that kind of just informs what I think about things at that point in time. Then I'll take a look at the portfolio, and I will determine if I need to make some sort of adjustment to the portfolio, if I need to add risk, remove risk, if I need to add risk, what kind of risk. Do I need long deltas, short deltas? So what I mean by that is, when I look at the entire portfolio, that's going to inform a lot of my decision making. There are some people I know that they typically just trade individual stocks in the opportunity that they see for the stock, and they might have a portfolio with two stocks, each of them at 40%, 50% of their total portfolio value. And some people can do really well like that. So I just want to be clear, as I talk about my perspective and my paradigm, is just, this is my approach. I'm quite different than that. I view my entire portfolio as kind of this big cog that I'm moving in a specific direction. And I'm constantly rotating puzzle pieces to keep this cog moving in that direction. So it definitely starts from top-down market approach, no doubt.
Yeah, that's the way that I'm trying to trade now, like kind of take that top-down approach and trading as a portfolio. A basket of trades, like maybe 10 positions or more in a portfolio, but looking at it as a whole, like managing it, allocating the risks as a whole, instead of looking at one trade at a time, like a single trade at a time.
Yeah, I think that's the way I looked at that for traders is you have to be able to do both. And I agree with you. I think the portfolio risk, the way I look at risk is twofold. I look at my portfolio risk, and then I look at the individual positions. And to your point, any one individual position doesn't quite matter that much either way, as long as I'm following my rules and applying it, and I can continue to do that long term. Okay, great. That's fine for that individual position. Now for the portfolio, the entire portfolio needs to take a risk profile shape that aligns with my objectives as the trader. And if I see any of that getting out of whack, then I need to look at the individual positions, modify those, adjust as needed, and then I can pivot things to get it back in line with my broad portfolio expectations. So the way I would offer on that, at least, is to consider both. I wouldn't alienate either side, but exactly what you're mentioning, I would make sure that we are considering the broad portfolio risk, because I have a video that talks about beta weighted deltas and how important that is. And it's because it's a way to view an entire portfolio's risk in a common language to get a sense of what does it even look like? Do all of these individual positions add up to something that makes sense for what I'm trying to do? Or do they not? And is my beta weighted delta profile completely different than what I thought it would be? And I need to make some massive adjustments because this does not align with what I think it should be. Now, over time, you develop kind of a baked in capacity to intuitively know exactly what you're looking at. But in the beginning, definitely using something like beta weighted deltas for guardrails is really useful for that.
Thank you for that. I think we missed a question or comment in the chat.
Yes, take a look. I see, I'm new on this, so I only know the basics. No, your questions are completely fine. It says, what kind of analysis is this and how can I improve my knowledge? I think, when did that come through? That was like 5 minutes ago. So we were talking about put skew then? Was that what we were looking at? So Fabio, from a high level, the general analysis that we're looking at is kind of using options chains and the data within options chains to inform some of our decision making. And for me, obviously, I'm primarily an options trader, so I'm baking this information into building typically, not exclusively, but typically options trades. But even as a stock trader, you can use options to inform some of what you're doing, even if you never trade an option. And then for the second question on how can you improve your knowledge, there's a couple ways you can go about that. I honestly think probably the best route up front would be to grab a copy of Options as a Strategic Investment. It's kind of like that's the book that's right there, actually. And it's a big book, but it's kind of like a really great all-encompassing overview of options trading. And then obviously you're welcome to check out my YouTube channel. The stuff that I do is not necessarily super beginner oriented, although there's tons of beginner content. I have a playlist for beginners. But yeah, I think that's where I would start. The main thing, and I have a post that I recently made that I can find at some point and maybe send it over to you guys. But I think one of the main things to keep in mind is that if you start learning about trading in general, not even just options trading, is that I genuinely believe we're at a point now where there's just pure information overload. There's no shortage of tons of information, which is kind of different than when I started back in 2007, where it wasn't information scarcity, but it definitely was not as prevalent as it is now. And I just find that leads people in circles, kind of like chasing their tails. So, oh, let me do this. I can find a version of the post, and then I can literally just throw it in the chat for you. And essentially the concept of the post is to try to help people create a better approach to start trading options. That's the entire idea. So this is going to be, yeah, I'll throw a post on my Substack with it real quick for you. And then I'll be able to share the link with you guys so that you can check it out. But the idea is to just try to make it a little bit easier to start trading. And the idea behind the post is essentially to create a roadmap for yourself. Because if I think about the process of learning, something that we fully lose specifically with trading is we lose any sense of organization And people tend to just start trading, right? We just start putting on positions. We just start trading different structures. And if you think about it, it's so silly to do something like that. It really doesn't make a lot of sense. Because if you think about anything that you learned in high school, in college, undergrad, grad, you get a syllabus. It's organized logically. There's going to be homework. There's going to be tests to validate your understanding of things. And there's really none of that for trading options. So that's kind of the idea behind the post, is to try to help people come up with that. So I am throwing it up right now, and you will be able to check that out.
Great, Erik. Thank you for coming on the show.
Oh, of course. Absolute blast. I love obviously talking about options. I love talking about trading. I'm happy to help. And I think for some of the future sessions, we'll be able to start kind of dialing in. I think it would be great to do a little bit of a deeper overview of options themselves, kind of how they behave, but then to start looking at strategies. I think that would be the great next logical step. But as always, open to feedback and whatever is best for you guys.
Fantastic.